Good evening, everyone. It's precisely 4 p.m. and the time when we can start with the webinar. A very warm welcome to all the participants joining the webinar, wherein we will be talking about employee benefit actuarial valuations. I'm extremely excited to share the fact that we have had an overwhelming number of registrations and participation for the webinar today. So thank you so much, everyone, for entrusting the team KPAC with your valuable time. So what is an actuarial valuation? Well, any valuation such as estimating the present value of obligation with respect to any employee benefit scheme like gratuity, pension, or even earned leave, which involves application of certain actuarial technique, is referred to as an actuarial valuation. One of the most commonly applied actuarial techniques is the use of decrement tables, or what we can also call in simpler words is a survival probability table. This involves estimating the probability that the benefit will actually be paid as and when it becomes due. I'm sure all of you would have had a discussion with your actuaries around the attrition rate assumption. So the objective here is that the actuary uses the attrition rate along with the mortality rate to derive a probability table, which what we spoke a little while back, the probability survival table. And the application of this probability table while evaluating the financial obligation of the organization towards the employee benefit scheme is what distinguishes an actuarial valuation. So there are different types of actuarial valuations that can be performed with respect to an employee benefit scheme. Funding valuation. The purpose is to determine the level of funds which are required to maintain the scheme solvency. Buyout valuation, wherein the objective is to determine the price of securing the benefits completely with an insurance company. And actuarial valuations, which are performed particularly for accounting purposes, wherein the actuary assists in the preparation of accounting disclosures, and these disclosures provide the necessary disclosure-related items which are required to be produced in the annual reports and accounts of the company. So the accounting disclosures can be prepared under various accounting standards, such as AS 15 and AS 19, IS 19, as well as US GAAP. Interestingly, the actuarial liability continues to remain the same under all the accounting standards. But what differs between all these standards is how the expenses are recognized and how some of the items are disclosed in the valuation report. Now, given that we are approaching the financial year end, I'm sure a lot of finance professionals will have already began their preparation for the year end activities. So we will primarily focus on the accounting related actuarial valuations. So now let us look at some of the key features of the actuarial valuation, which is performed for the accounting disclosure purposes. Firstly, it provides true and fair value of the scheme's financial position, which means both the assets as well as the liabilities, these are marked to market. The actuarial liability valuation is performed using market-linked assumptions, which is the discount rate adopted is mark to market, and the assets are taken at the market value as on the balance sheet date. So the valuation provides a true and fair value of the scheme's financial position. Secondly, the accounting valuations are performed using assumptions which are unbiased, more of which we will discuss in some of the slides to follow. But what it precisely means is that the actuarial assumptions that are used in the valuation process are neither over-prudent and nor these are under-prudent. What it means is that it helps to recognize the realistic cost. That is, the cost is determined as what it should be, because the actuarial liability ignores any form of prudency element. Now, why is realistic cost assessment important? Simply because of the fact that actuarial valuation results are presented in the annual reports and accounts. And these form a useful disclosure-related items for all the stakeholders, say shareholders and other users of the accounts. So it helps all the stakeholders form a real picture and assess the company's obligation towards these employee benefit plans. And lastly, the accounting standards are mostly prescriptive in nature, which means that the accounting standards pretty much prescribe the actuarial methodology to be used and how the actuarial assumptions must be determined. Thus, this prescription ensures that the organizations adopt a consistent practice year on year, as well as the practice is consistent for all the companies across the entire industry. Thus, it makes it easier to review the performance and compare the results both year on year and across different companies within the same sector. Now, given that we have already looked at some of these key features of actuarial valuation, we will now look at how these valuations can benefit the management. Now, access to the actuarial valuation results and reports provide a very good understanding of the nature of liability profile. That is, it provides insight to the following. First, how much of the liability is expected to fluctuate due to variations in the key actuarial assumptions? Secondly, what is the expected timing of the benefit payment? And thirdly, what is the size of the corresponding benefit payment? Now, when the management has access to all such informations, it helps them to make a lot more informed decisions. For example, determining a suitable investment strategy for their employee benefit plan, which could be gratuity, pension, earned leave, or any other benefit plan. Now, given that there is access to such wonderful quantum and quality of information, the organizations can certainly adopt a well-suited asset liability management investment strategy, which is also extremely useful for risk management. Because what it does is that such an investment strategy allows and ensures that both the market value of assets as well as the market-linked liabilities, these move in sync with each other. Such a strategy also ensures that the employee benefit plan will always have access to adequate cash and cash equivalents to meet the benefit payments as and when these become due, thereby helping the organizations to manage liquidity risk. And secondly, such a strategy also helps to hedge the liability movement against any fluctuations in the interest rate, which is a key actuarial assumption. For example, a fall in the interest rates will increase the actuarial liability. But in case if the employee benefit plan adopts a proper asset liability matching investment strategy, then it will ensure that both the assets as well as the actuarial liability move in a similar quantum. What it will do is it will help to protect the scheme funding position and also maintain the net balance sheet position, because the net balance sheet position will then more or less remain unaffected. Further, the management can also obtain the valuation results under a range of valuation assumptions, just to understand and determine the affordability as well as the feasibility of the benefit plans, particularly under the extreme circumstances. Now, the access to such information is extremely useful to determine if the management can afford to offer maybe a more generous benefit plan, which may eventually lead to better employee retention, or it may also identify if there is a need to further optimize the benefit plan, obviously considering subject to any regulatory restrictions. Thus, access to all the information which the actuarial valuation results and reports provide can help the management to make several decisions in a lot more informed manner. And lastly, actuarial valuation disclosures, these also ensure that the organizations are always on the right side of the compliances, thus satisfying any regulatory requirements also. Now, given that we have also now had a look at how the actuarial valuations can benefit the management, let us quickly look at the role that the management can play in order to ensure successful enablement of these actuarial valuations. Firstly, the management must maintain accurate individual employee data. The individual employee data could be date of birth, date of joining, and salary details also, much of which we will discuss at length in the actuarial valuation process. Secondly, the management must also regularly collaborate with the actuaries on some or maybe all of the following items. One, setting the actuarial assumptions. Uh, in fact, the management will always have greater insights about what is happening within the organization. So they must regularly communicate with the actuaries around what the assumptions could look like in future, depending on their future expectations, say for salary growth rate and attrition rate. Again, we will be discussing all of these key actuarial assumptions at length in the actuarial valuation process. They should also regularly discuss with the actuaries regarding the developments in the market. Say, for example, how is the interest rate behaving of late, or if there are any regulatory updates that are happening around the industry, which can possibly affect the valuation results. So regular collaboration with the actuaries can help the management to understand what could be the possible impact on the actuarial liability, what could be the possible impact on the expenses, and how these can be further taken care of, as in how these can be optimized or how these can be recognized in the books of accounts. And the management should also understand the possible financial implications both on the scheme as well as on the company if any of the employee benefits were to be funded either in advance, which is via regular contributions, or if these were funded as and when the benefits were to become due. Lastly, the management must also take responsibility to ensure adherence to any prevailing regulations around the benefit, around offering of the benefit plans. And they must also ensure disclosure of all the necessary items required in the annual reports and accounts. So we will now look at some of the common employee benefit plans and their actuarial valuation requirements after having looked at the role that the management can play in the entire valuation process. However, before we actually look at the type of benefits, it is also important to know and identify the conditions on how a benefit can actually qualify for an actuarial valuation. And there are two primary conditions which a benefit plan must fulfill. One is that the benefit which is offered must be allowed to be carried forward to the next year. That is, the benefit, if not utilized in the current year, must be allowed to be taken forward the next year. Secondly, the benefit must be accumulating in nature. Now, given the broad variety of benefits that an organization can offer to their employees, these are broadly bracketed into four heads, and these heads are as defined in the accounting standards. The first one is the post-employment benefit plan, which can either be defined contribution in nature or it could be defined benefit in nature. Actuarial valuation requirement is usually non-negotiable for a benefit plan which is defined benefit in nature. Something like a gratuity, a pension plan, which wherein the risk is completely on the employer and the benefit continues to accrue and is dependent on the service. And similarly, a long service award plan, wherein the benefit is payable on separation, provided it satisfies the two conditions that we discussed a little while back. Secondly, other long-term benefit plans. Again, the actuarial valuation is generally non-negotiable for this category of benefits also. It includes benefits like earned leave, which are generally accumulating in nature, and also because of the fact that earned leaves are generally allowed to be carried forward, in future in case if the leaves are not completely utilized in the current year. And it could also include any long service award benefit plans wherein the benefit is payable during the service of the employee. However, the award payable depends on the service rendered until now and something which is not allowed to, which is allowed to be carried forward again. The next are the short-term benefits. These usually include sick leaves and casual leaves, which are generally not allowed to be carried forward. And hence, these benefits do not generally meet the actuarial valuation requirement conditions. However, the policy and valuation requirements may eventually vary across different companies, depending on how the policy is structured. The next are the termination benefits, and again, the valuation requirement may generally vary depending upon the scheme policy. So nothing which is universal out here as well. So up until now, we have majorly covered all the ancillary items to the actuarial valuation process.